Welcome to The Explainer, everyone. Let's jump right in. Today, we're breaking down Wells Fargo's massive first quarter 2026 financial results. We're going to unpack everything from their headline earnings and regulatory capital requirements, all the way to some really fascinating preferred stock valuations. Look, if you follow the banking sector, you know there's a lot of noise out there right now. But we're going to strip all that away and look strictly at the data to make these complex numbers incredibly easy to grasp.
To keep us perfectly on track, here's our roadmap for today. We'll start with the 1Q26 earnings snapshot, then move into diving into segment performance, capital, liquidity, and safety, the preferred stock landscape, and finally wrap up with market sentiment and outlook.
All right, Section 1, the 1Q26 earnings snapshot. Let's unpack these headlines.
$5.3 billion. That is Wells Fargo's net income for just the first quarter of 2026. Right out of the gate, that number sets the stage for the sheer financial gravity of this institution. It's a staggering figure, but to really understand its impact, we need to see how it actually stacks up historically.
So, zooming out to look at the year-over-year picture, total revenue grew a really solid 6% to $21.4 billion compared to the same time last year. Now, net income did see a tiny dip if you look quarter over quarter from the end of 2025, but year-over-year, it's up 7%. Meanwhile, non-interest expense crept up just 3% to $14.3 billion. So the top line is growing faster than their expenses, which is exactly the kind of leverage you want to see.
Looking closely at the raw data straight from the source, a couple of key performance indicators completely jump out. They confirmed a 12.2% return on equity, which is extremely healthy for a mature, heavily regulated bank. But even more impressive, their pre-tax, pre-provision profit, which basically measures their core operational profitability before setting aside any money for bad loans, that jumped 14% to $7.1 billion. The core engine of this bank is absolutely humming.
Moving on to Section 2, diving into segment performance to see exactly where the money moves.
Now, this is a fascinating trend. Net interest income, or NII, hit $12.1 billion, up 5% from a year ago. In what's been a pretty complex interest rate environment, this growth was largely driven by higher deposit balances and fixed-rate asset repricing. Basically, they were able to charge more on certain assets to easily outpace what they were paying out in yield.
Peeking inside the corporate and investment banking segment, specifically their $36.2 billion corporate debt finance portfolio, you can see exactly how they manage risk. It's all about diversification. Their collateral is heavily spread out, with the top three sectors being business services at 19%, software at 17%, and healthcare at 15%. They are very intentionally spreading their bets across structurally resilient long-term industries.
The absolute lifeblood of any bank is its deposits, right? Well, average deposits climbed 6% year over year to a staggering $1.4 trillion. And this wasn't just isolated to one lucky area. It reflects broad-based expansion across their consumer, commercial, and corporate segments. Bringing in that much capital at an average deposit cost of just 1.43% gives Wells Fargo a massive, massive advantage.
And we have to talk about wealth and investment management, which was a huge bright spot this quarter. Revenue surged 14% to nearly $3.9 billion, supported by an incredible $2.22 trillion in client assets. Over in corporate and investment banking, revenue was up 4%, getting a really nice tailwind from an 11% jump in investment banking fees. And of course, consumer banking continued to provide a steady anchor, reliably churning out over $1 billion in net income.
All right, Section 3, capital, liquidity, and safety. Let's measure the moat. Whenever we talk about bank safety, the Common Equity Tier 1, or CET1 ratio, is basically the holy grail. It's a regulatory metric comparing a bank's core equity capital against its total risk-weighted assets. In plain English, CET1 is the ultimate measure of foundational strength. It tells us exactly how well a bank could absorb a sudden, severe financial shock without collapsing.
So here's the crucial takeaway. Wells Fargo's CET1 sits comfortably at 10.3%. When you compare that to the regulatory minimum of 8.50%, it's crystal clear they have a very wide buffer. We're talking about $135.4 billion in Common Equity Tier 1 capital. They aren't just skimming the minimums here, they are built like a fortress to weather pretty much any potential economic downturn.
Then there's the Liquidity Coverage Ratio, or LCR. This is a requirement for banks to hold enough highly liquid assets they can literally turn into cash today, to fund short-term obligations over a 30-day stress scenario. Think of it as the bank's ultimate rainy day fund.
And brilliantly, Wells Fargo boasts a 120% LCR. This means they actually have 20% more high-quality liquid assets on hand than regulators strictly require them to hold for a 30-day survival run. It is a phenomenal indicator of their short-term liquidity strength.
Section 4. The Preferred Stock Landscape. Evaluating WFC-PRA.
So you might be wondering how exactly do preferred shares fit into a strong banking environment like this? With the stable liquidity and deep capital buffers we just explored, income investors often look to a bank's preferred shares for a steady, reliable yield. But determining if it's actually a good investment requires looking closely at current market pricing, not just the brand name of the bank. For this explainer, we're focusing specifically on the Series AA preferred shares, trading under the ticker WFCPRA. These shares carry an original coupon rate of 4.70%. Interestingly, they actually became callable in late 2025. That means Wells Fargo has the right to buy them back, though they are currently trading right past that call date.
Now look at this because there is a massive valuation discrepancy here. The liquidation preference, essentially the par value, is $25 flat. But right now, these shares are trading in the open market at roughly $18.23. That's a steep 27% discount to par. Because the price is pushed down so much, the current dividend yield gets pushed up to a very attractive 6.45%. For income-focused investors who firmly believe in Wells Fargo's balance sheet, that particular discount and yield combination is definitely turning some heads.
Finally, Section 5. Market Sentiment and Outlook. The road ahead. Now, it's not all perfectly rosy. Despite the incredibly strong top-line revenue and net income numbers we covered, market analysts, like the folks over at Panda Forecast, point out some mixed macro signals. They note that Wells Fargo has shown a bit of vulnerability regarding net interest income resilience when compared to its closest Wall Street peers, like Goldman Sachs and Citigroup. This is especially relevant as the broader banking sector tries to navigate shifting interest rates and tightening profit margins.
When we check in on standard equity valuation metrics, they paint a picture of a mature, steadily valued financial giant. The trailing price-to-earnings ratio sits at a reasonable 13.47, with a forward PE dropping down to 12.38, which suggests the market is expecting some slight earnings improvement. The common stock offers a dividend yield of just over 2%, backed by a really solid $6.47 in earnings per share across more than 3 billion outstanding shares. It's a massive, stable ship, even if it's not a hypergrowth tech stock.
Which leaves us with this final, provocative thought to chew on. As economic cycles inevitably shift over the coming quarters, will Wells Fargo's $1.4 trillion in deposits and their massive, industry-leading liquidity buffer be enough to outpace the tightening margins of the broader banking sector? Are these vast assets an anchor slowing them down, or are they the ultimate shield in an uncertain economy? Definitely something to think about as you review the data. Thank you so much for joining me on this explainer, and keep learning.